Hello and welcome to the Monday Futures Market Outlook for April 23rd, 2012. This is Patrick Sresna. For those of you that have not had the opportunity to try out the eminisource.com trading room, complimentary memberships are available on the website. As always, we start off with a chart of the US dollar index, and we always try to understand the trend of the US dollars and the effects it will have on the broader markets. You can see we've continued to channel in a tighter and tighter coil between a very flat range. In the bigger picture, we actually do believe there are the right situation or circumstances for a strong US dollar rally at some point, but there's simply zero technical evidence that something like that is about to begin or has begun. In the bigger picture, we are looking for some indications that the US dollar strength could come in here, but it would take a substantial increase above the 80-81 level to indicate that that something bigger picture is underway. Otherwise, so long as the US dollar, even if it breaks this kind of tightening wedge, so long as the overhead and underneath support and resistance lines stick in there, then we will be in a range-bound dollar for a little bit longer. Next year, when we take a look at the Euro futures, one of the reasons we still think that there's room for the US dollar to be bullish inevitably when it breaks that range is going to be on whether or not the Euro breaks down. The one area we continue to watch is around this 132 and a half area, where again we've had a number of tests and failures. So long as the Euro fails to rally above that zone, and that support line at the 130, 131 level at some point will be tested again. Inevitably, at some point, if the Euro does break below 130, it really would open the window for a substantial debasement of the Euro all the way back down to its January lows around the 126 level. It would be in an environment like that from which the US dollar would be allowed to have substantial strength. Next year, when we take a look at the 30-year Treasury bonds, we continue to see money coming into the bond markets after that short-term low. Really, at this stage, even the 10-year Treasury is right near its highs, if not pushing to all-time highs in terms of low yields and high bond prices. Really, at this stage, we definitely are seeing money coming into these bond markets. Overall, we don't believe that these will have any substantial move on this first push. This 30-year Treasury bond likely will have substantial overhead resistance in the next 2-3 handles higher. But inevitably, in the second half of the year, particularly if driven by a very strong US dollar move, we could see a substantial breakout in Treasury bonds. And so we'll be watching what environment that would be in when that would occur. So we're right now on the short term over the next month or two, we don't anticipate Treasury bonds to have much more than a few handles higher before they hit some overhead resistance. Next year, I want to take a look at copper prices, and copper continues to be bearish. We have been watching that 370 level marked by the blue line as a break of the trend or the sideways consolidation. For the last 2 weeks, we've now been consolidating below there. That 360, 365 level marks some of the ranges where highs have come in last year in that October-November cycle. And really, at this stage, if we have any substantial weakening below this level, really copper can move all the way back down to the lows of the second half of last year, somewhere around the 330, 320 levels on the downside. So we're going to be watching whether or not the support line gives. If it certainly would be a circumstance where we could see that weakness if the US dollar began a strong move on the upside. Next year, when we take a look at crude oil, crude oil has been playing a game around this key support line along the 101 to 103 level. So long as that support line is held, there's certainly room for crude oil to become bullish on the upside, to not only retest its previous highs, but maybe even push 114, 116 on the upside. But if for whatever reason we have crude oil substantially debased from here below the 101 level, and particularly if it gets into the mid-90s, like $96 to $98, it would probably mark a substantial top in the crude oil price. It doesn't necessarily mean that a geopolitical catalyst could not come in and create a substantial increase, but with all those kind of catalysts removed out of the equation, there would be room for crude oil to start debasing down into the 90s and maybe even high 80s in the bigger picture. But before we make any bearish calls on crude oil, we first need to see what resolution we have at this 101 level. Understand, we remain neutral to even slightly bullish on crude oil so long as the support line holds. The only circumstance where we start looking at bearish scenarios would be if we saw a substantial drop lower than these support lines. Next year, I want to take a look at gold and particularly the bullion prices as it's now trading at this 1630 level. Really, at this stage, we've been looking to see whether or not a wedging formation here would find support lines around the 1640, 1630 level to turn bullish. Right now, gold bullion has now weakened down to these levels again, and we're at a make it or break it moment, because if these levels start giving out on the downside and we see further consolidation below 1630, it would certainly open the window for a drop down towards the lows of last year, which all lie around that 1540 to 1560 level down below. So let's watch whether that support line holds. Otherwise, a lot of bear scenarios really open up for a downwards move. That brings us to wanting to look at the S&P 500. As always, we start with a weekly chart with going back 30 years and with an 80-week moving average on there to depict the primary trends. And when we add that moving average, you can see every major bull and bear market cycle that has occurred in the last 30 years. What we've seen in last couple of years is a couple chop signals that have broken above and below this level. Now, this is going to be a crucial story here, because that 80-week moving average lies somewhere around the 1280 area on the upside in a rising fashion. Now, as this correction is underway, we more than likely will see the S&P move to test levels like 1330 or even that 1275 level. So long as the bulls can dig in and hold the support lines along this 1275 level, then there's room for the market to turn bullish again. But understand that if we in any way start to see consolidations that start breaking that later this year, then that might mark the beginning of another down cycle. So we're going to be watching how support lines hold during these corrections. So when we take a look at the daily chart of that S&P 500, we drew that trend line many weeks ago, marking all those lows, and we were basically suggesting that a break of that would mark probably the beginning of this correction. Now that we've seen about 8 days of sideways consolidation, the market here is again attempting to break down. This will be a crucial moment, because if this 1360 level on the S&P futures gives out, it really does open the window for a drop down towards the 1320 to 1340 area on the downside. We actually think that there's a very good chance that 1320 to 1340 area does contain all the selling. But there's always an opportunity for this market to accelerate on the downside and maybe even test that 1275 to 1290 area. We still do believe that this is simply a market correction, which means that at some point it represents a buying opportunity. So while we certainly are forecasting this to go lower, we are looking at that as an opportunity where we can get in and participate into this market. So that brings me to want to look at the key intermarket observations. We've stood over a month with this short-term neutral stance on everything. We felt that it would be sending the wrong message to even give a short-term bear signal on stocks, because we don't want there be an overemphasis on shorting this move lower, but rather we will move our stocks to even short-term bullish if we see there to be a short-term bottom in place and a potential rally back up to the highs. In the same regard, the bonds, this initial leg higher, we still remain neutral. But if we see a good, healthy consolidation in the next month or two, then we may actually turn bullish on bonds as well. But more than likely, that would be eventually to the tail end of the summer. Commodities would slowly become bearish, particularly if the US dollar finally gave a signal to become bullish on this move. So really at this stage, we remain relatively neutral on many of these fronts. Because of the nature of the current market, but we will take some more decisive short-term stances in the upcoming weeks. That was your Monday Futures Market Outlook. Thank you for joining me.